All three of these companies are up 50% from the last year. So it's been a very productive year for the royalty and streaming space in general. And I guess what we want to figure out today is if there's still room to grow, if this is an investment that people should be focused on in their portfolio, or if there's somewhere else better to look. So, without further ado, can you guys each give us the 15-second overview of who you are, who you work for, and that's about it? Dave, maybe starting with you.
Sure. Thanks very much, Jamie. So my name is David Awram. I'm one of the co-founders of Sandstorm Gold Royalties, along with Nolan Watson. So Sandstorm, we have a market cap of around, I think, 1.25 billion US or so. We've been around for just over 10 years now. We have streams, I think cash flow coming from 22 different projects right now worldwide, and that's going up to about 27 or by 2023, 2024 different projects. So what we've been specializing in is really gold and silver streams and royalties. We're looking at a whole range. We also have a big portfolio of exploration royalties in the background as well too. Randy.
My name's Randy Smallwood. I'm president and CEO of Wheaton Precious Metals. We founded the company. We spun it out of Goldcorp. I was at Goldcorp when we created the original silver Wheaton. So market cap in excess of $15 billion now. 20 assets producing and another 9 development projects around the world. A real strong focus on quality of investment. We focus on investing into ounces, not acres. So.
Thanks, Randy. My name is Dan O'Flaherty, the CEO of Maverix Metals. We founded the company in July of 2016, so just over 3 years old. We have a market capitalization of US $600 million, a portfolio of over 100 royalties with 14 of them that are cash flowing. We're very much focused on precious metals with 94% of our revenue coming from gold and silver, predominantly from Canada, the United States, Australia, and Mexico.
All right, so we've got a range of companies here from an $800 million market cap all the way up to a $16 billion market cap. So it gives us a good sort of oversight of what's going on and the opportunities in this sort of this niche of the sector today. But I think because we're going to be talking about streams and royalties, it's best to first start by defining that. And Dave, would you be able to give us a brief overview of the difference between what a stream is and what a royalty is?
You know, they're both fairly similar type of products. One, however, is a contract that sits on top, where you get a percentage of production, but you give an ongoing payment back. You actually do receive the actual physical delivery of whatever commodity that you're streaming at the time too, which you're able to sell. A royalty is really just a cut of the revenue. So the product gets mined, it gets sold by the mine, and then the mine pays you back a percentage of the revenue, net of a few other deductions of it, depending on what type of royalty it is, back to you. But they're very, very similar products. In the end, they function really as a cut off of the top line, the revenue of the mine itself.
So we know the difference between a stream and a royalty, but this can be further complicated. So when you're looking to invest in a company, there are cash flowing royalties, and then there are non-cash flowing royalties. So cash flowing royalty would be a royalty or a stream on an operating mine versus an exploration project or a development stage project, which is not cash flowing. And Dan, can you kind of give us a bit of an overview of what you think would be the ideal portfolio for a royalty and streaming company in terms of cash flowing versus non-cash flowing and growth assets?
Thanks, Jamie. I think it's unique to each company and where it is at its stage of growth. When we first launched the company, we had 2 cash flowing royalties, so we were very much focused on cash flow. We've grown that to a platform of now 14 cash flowing royalties, so we've recently added to the back end of the portfolio, specifically with our most recent acquisition that had a number of development and exploration stage royalties in it. So I really think a nice blend between cash flowing, which has defined immediate production, as well as development assets that have long-term optionality.
So where are the royalty companies that don't have any cash flowing assets yet? They're all in the development stage. Where's the value there for potential investors?
I think it's on a longer term basis where those assets as they get developed come into production versus immediate cash flow, which again, you're able to redeploy into acquiring additional assets with that cash flow and continuing to build a portfolio.
Okay. So, Randy, Wheaton Precious has kind of built its reputation on streams in Tier 1 and Tier 2 assets. There are not many of those in the world. You guys spend a lot of time before you do any deal. Where are you growing? How are you going to keep up that model?
Well, I think we've had a pretty good track record of doing that. We are very selective about what we invest into. I would say the key thing behind streams, and it's a difference that I would highlight in terms of a difference between a stream and a royalty, is a stream is truly a partnership. It's a contractual relationship between two corporate entities that work together beyond the upfront payment, whereas a royalty is generally just sort of hiding in the background and collecting a check every once in a while. And so one of our best sources of growth opportunities is our existing partners, and we've actually had a great track record of continuing to grow relationships within Glencore and Vale and some of the largest companies in the world, because they realize the benefit of working with us as a streaming partner on a go-forward basis. And so that's where a lot of our opportunities come from, is the fact that our partners are really happy working with Wheaton in terms of what we deliver beyond the upfront payment and beyond the production payment, how much extra effort that we put in to try and help our partners be successful. We have this underlying mantra at Wheaton Precious Metals: the more successful our partners are, the more successful we are. So we are constantly looking for ways to continue delivering value and help our partners be more successful. And that in itself will provide all sorts of opportunities. But the other beauty of this source of capital is that a stream, which definitely delivers more value than a royalty on a per ounce of metal basis. So if a company has a bunch of metal and they're trying to source capital going forward, a stream will deliver more value on a per ounce basis than a royalty will. But the other advantage is that it also always improves the internal rate of return of whatever project or acquisition that money is going into. And that being said, the amount of capital that we contribute at the start of an acquisition or a development process compared to the amount of revenue that we take away as part of our stream always improves the internal rate of return. And that fundamental number, that fundamental reason that will drive continued interest in the streaming industry. That's why we keep on having people knocking on our door looking for capital. We are blessed to be in a business that will always need capital. The three of us all supply capital. Basically different risk profiles between the three of us, but that's where we're going to get that space.
So Randy, what is your view on royalty and streaming companies taking equity positions in the companies that they're buying a stream or royalty on?
Well, again, I think it comes back to support for our partners, and sometimes it works in that sense. It's not something that is part of our core mantra. We believe that we can just go forward on the streaming business, and think if the market was fully efficient, we would have the equity investors out there providing the support. I don't think the streaming industry should ever think it's the only source of capital. I think that whenever it comes to a mining company actually funding a project going forward, that it should be a good mix of equity and debt, and I would call a stream as part of the equity side of that equation, and pushing that in place. And so, I just think that a balanced approach in terms of finding that funding. Now, the equity markets have not been supportive of late, and what that has done is forced a bunch of the streaming companies to step into that space and provide some of that support.
Yeah, and Dave, you might be the best person to speak to that, because Sandstorm has done a very good job of helping to support or seed smaller exploration companies or even bigger ones with an equity component with their stream. What are your thoughts on that and the role it plays for you guys?
Well, one of the things you have to keep in mind when you're creating what is going to be a successful stream is to make sure it doesn't take too much of the economics of any given project. We know that that's been a problem in the past as this sector has evolved. So in the end, you create a good stream by making sure that partner company is going to operate well. Us as streaming companies, in the end, we're the ultimate long-term investor. Once you enter a stream, you really struggle to find liquidity in that stream after. In fact, you don't expect to ever get liquidity in that. You just expect that stream to exist until the mine is run out. So your job as a streamer is to make sure that partner can effectively exploit that project to the maximum. And many times that means coming in different parts of the capital structure. So what we've done is we have deal, you take a look at some of our more recent deals, we'll come in with a stream financing. However, we'll supplement with equity, we'll also supplement with convertible debt or any kind of other structured debt in there. We've even offered at times to be part of the project financing package that goes forward. Anything in order to make sure that that partner has the best possible chance of getting the project up and going and operating it and continuing to invest additional capital into the project. You know, keep that in mind. We as streamers, we want to make sure that our mining partners continue available capital to them throughout all parts of the cycle, because mines always need new capital going into them. And it's upon us to make sure a structure is created that's going to allow them to access that capital in the future.
So guys, what are the average margins of a mining company? Your typical mining company, a good operating one. Do you guys have a feel for that?
Hopefully positive.
Okay, so what are
But not always.
What are the average margins for a streaming and royalty company?
Streaming, I mean, royalties generally don't have any type of production payments, so it's it all comes down to you know, whatever you're getting for the metal that gets delivered to you, or the cash that gets delivered to you. With streamers, typically you're dealing with 70 to 75% margins. It can climb up. We've been as high as 85%. There's been a real push lately to push down the production payments in new streaming contracts.
Yep.
It's a little bit of a challenge from a treatment perspective. There is a reason why there's production payments. They are supposed to be focused towards covering the bulk of the cost of producing that metal, and so we see some younger startups in this industry trying to sort of undercut, and I just don't know if they understand some of the risks associated with those kind of moves. But yeah, it's typically 60 to 80% depending on where the commodities are at the time.
So I guess where I'm getting with that is sort of streamers and royalty companies are very much protected from the downside because of these strong margins, because they don't incur as many of the risks. Dan, maybe you could speak for a second on, are you as competitive in a good market with a rising metal price as mining companies? How do streaming companies react to the upside?
That's a great question, because as you mentioned, in bear market environments, those very strong margins provide royalty and streaming investors with some downside protection. What's more exciting is the upside. In rising gold price environments, it's a very good environment for the royalty and streaming companies. Our underlying operating partners are investing significant amounts of capital into their own assets for the benefit of their shareholders. The royalty and streaming companies share in that benefit as well, whether it's exposure to exploration, exposure to new mine development, exposure to mine expansion. We share in those benefits with our partners. Again, that's one thing where Maverix has over 100 royalties, 14 of which are cash flowing. So there's over 80 assets that we have exposure to that are not currently in production. So to the extent a rising gold price environment makes those projects more likely to be constructed, that gives significant torque to the upside in the gold price. So very strong gold price leverage for the royalty and streaming companies.
Dave, is there a scenario where you would rather buy a mining company than a royalty or streaming company as a personal investor?
Well, I mean, the streaming and royalty companies are really about that risk-adjusted reward investment. You know, what you're getting when you buy a royalty and streaming companies is, sure, you get those great margins, but I think really very importantly, you're looking at locking in that capital. So once the stream is invested in, it's really just cash flow from that point onwards. You get payback on your investment. You're not putting additional capital back into that project in order to receive that expected cash flow or the cash flow from that mine. And that's a big difference too, as to what you were talking about before, is that lack of requirement of additional capital into that project really conserves that cash flow for the future, which gives you that certainty. And as a result, that really does, as an investor, provide you with much lower risk as to where that capital ends up floating around in the future. Listen, are there times when makes a lot of sense to buy a mining company? For sure. When you're seeing a rising gold price environment, you're typically heavily levered companies are going to go up in value at a high rate, especially if their cash flow, free cash flow, goes from negative $100 to positive $100. That makes a big difference to really how the market's going to value them. However, owning or streaming a royalty company as a base of your portfolio only makes perfect sense if you're interested in this space at all. And it's something that everybody should really kind of consider as having a core part of their investment portfolio.
So, as everyone here is probably well aware, we've seen a lot of consolidation over the last couple of years in the gold mining space. Randy, when are you guys going to start buying other streaming and royalty companies?
Well, and it has happened in the past, and in fact, one of our more attractive acquisitions was a company called Silverstone back in 2009, and it has given us, we've done very well in that investment, and there's a lesson learned there. Those are third and fourth quartile assets. They're not the best quality assets, but the price was attractive enough for us to step in and do that. That being said, most of the streamers and royalties, for all the reasons, the low risk profile and the great exposure that we provide to precious metals as a place to invest, we trade at multiples to NAV, and yet we can make acquisitions in the space at about NAV. And so to go out and consolidate in the space doesn't have a lot of value. It's not the best way to deliver value back to our shareholders, especially when we see opportunities in the mining industry to go out there and grow our own exposure. And we do see a lot of that. As getting back to the fundamental basis here is that the mining industry always needs capital, so there will always be opportunities. I think the trick is to be patient enough to wait for the best quality opportunities out there and build up that portfolio in that direction. So I don't see a lot in the M&A side. I know we went through a very extensive battle with the CRA for quite a while and traded at a substantive discount. And I think if there was ever a chance of someone making an acquisition, it should have happened then for us. And I thought we were going to be a victim, but we've survived through that, and we're now delivering a lot of that lost value back to our shareholders. And unless there's a mistake, and I would say that what happened with Silverstone was a mistake. They made a poor investment. Their shareholders punished them, and we see an opportunity. We're always ready to move into that, but there's not going to be big moves in that space. What's the longest you've ever waited without doing an investment? Well, there's times to invest and there's times not to invest. In my 15 years of this streaming, there's 3 cycles to this industry. There's the development phase, which is when we're helping companies build assets and build mines and grow their own portfolio. Then there's what we call the harvest phase, which we went through from 2010 to about 2013. Commodity prices are so high, that's not the time for us to be making investments. We didn't make a single investment in that period. So it was about a 3-year period without any investments. Call that the harvest phase. We did very well in terms of cash flow from our original investments beforehand. Then the third phase we called the balance sheet repair phase. And that's when we sat and helped out companies that had over-levered themselves in that harvest phase and spent too much money on a booming commodity price market and needed some support through that stage. I think the last transaction on that basis was probably our Sibanye deal back in 2018. I can tell you that the opportunity set has definitely shifted back into the development phase. The companies that we're talking to, they're putting the money back into the ground. They're sourcing that. And the harvest phase, to be honest, we're not making investments, but we're reaping the cash flows of all our investments. It's quite an enjoyable time.
So I'm getting 2 minutes left there, and I have about 30 more questions on here, but perhaps to wrap it up, could you guys maybe each give a 30-second overview of why you think shareholders should own your stock, and not the other 2 maybe?
Well, first, thank you, Jamie, for hosting this panel. I'll give a shameless plug to Resource Insider. I'd encourage everyone to check that out.
Thanks.
But Maverix is the newest entrant to the precious metal royalty sector relative to our 2 peers here that are much larger. We've been one of the fastest growing in the entire kind of sector, starting with 2 cash flowing royalties in 2016, up to 14 now over a 3-year period. We look to continue to grow. We're doing exciting things. We just listed in the New York Stock Exchange last year. We've just put in a dividend inaugural. It paid last week. We've got a lot of exciting steps ahead of us to grow the company.
Great. Thanks, Dan.
We created the streaming model 15 years ago. We've got an incredibly strong portfolio of assets. We actually, even though we've been around for 15 years, have much fewer assets by number than my two peers beside us here. It's really because we like leaving the lottery tickets for the other companies out there. As I mentioned, we look for ounces, we don't look for acreage. We focus on good quality assets that have a real probability of delivering metal to our shareholders within the foreseeable future. We've got over 60 years of reserves and resources in front of us. We produce more metal than any other streaming company or royalty company in the space, and we've got good, strong organic growth on a go-forward basis. I really do think it comes down to appetite for risk. The streaming/royalty space is a step down in risk level from a traditional mining investment, but even within that, there's a diversity of risk within that group, and we're a very, very low risk option. Good, solid assets delivering good, solid metal.
Thanks, Randy.
So Sandstorm is going, over the next 3 years, from $70 million in expected cash flow up to $140 million in cash flow. We've got the strongest growth profile of cash of projects coming online. We have close to 200 assets altogether in the company. We've gone through a good aggressive share buyback program really during where the market was down. We're looking to transform ourselves into more of a dividend-paying company over the next year or so. So it's going to be a good transformative year in a couple of years as we see that cash flow increase. We continue to do deals like we've done in the past, which have great exploration upside on them, and have turned into some of the premier developers and producers in the industry. So Sandstorm's been around for 10 years, but we still are anticipating to have tremendous growth over the next 10 years.
Great. Thanks a lot, guys. Appreciate that. Thanks for watching, everyone.